If you're dreading tax season because you have no idea what you owe, or worse, you're thinking that you're leaving thousands on the table because your CPA is always behind, here's what changes everything: understanding how the IRS actually sees your business. In the next few minutes, I'll show you the simple framework that puts you in control of your 2026 taxes instead of scrambling in April. Let's start with the first big concept: how the system actually taxes you. Most business owners think taxes begin and end with federal income taxes, right? But that is only one piece of the puzzle. You also hit with payroll taxes on the salary or guarantee payment, state income taxes, and in many state, local, and city taxes on top of that. For example, if you pay around 20% federal income taxes, 15% in self-employment taxes, 10% state taxes, and then 3% locally, you can easily end up about 50% in total taxes. This simple mental model is this: revenue minus expenses equals profits, and profits is what gets taxes. So if you're making around $1 million in revenue, spend $600,000 on expenses, and then keep $400,000 in profit, you might owe close to $200,000 in total taxes. This is where strategy comes in, because once you understand how profits show up on your tax return, you can start learning how to structure it and then reduce the portion that actually becomes taxable. And the biggest piece of the puzzle is the type of entity you choose, which completely changes how your profits flow through your tax return. So let's talk about that next. Moving to the second key concept, let's talk about entity types and why they matter. Your entity type determines where your profits goes and how much of that ends up on your personal tax return 1040. Most small business owners operate through pass-through entities like LLCs, sole proprietorships, partnerships, or S corporations. And with these, all of the profits flow straight to your personal tax returns, where you pay taxes at your individual rate. The only structure that pays its own taxes is a C corporation, which pays a flat 21% corporate tax. And then when you distribute money to yourself as dividends, those dividends get taxed again. That's why people call it a double tax. But the C corporations also come with a powerful benefit structure that can help owners if they are used correctly. Understanding the differences here really matters, because if your entity type does not match the way your business makes money, you can end up paying far more than you need to. But entity choice is only half of the story. The type of income you earn can also change how much you pay in taxes. And this is where wealthier business owners have a huge advantage. Let's break that down. The third concept you need to understand is the different types of income, and then why the wealthy often pay less. Income is not all taxed the same, and that's why some business owners pay higher rate than investors who have the same total dollars coming in. Earned incomes like W-2 salary, guarantee payment, and self-employment income is hit with payroll taxes. So this is usually the most expensive kind of income. Portfolio or capital income like long-term capital gains or dividends is often taxed at a much lower rate. And that's why wealthy owners love this kind of income, because they can control the timing of when gains are realized. Then you have passive real estate income. With depreciation and special grouping rules, many real estate investors legally pay very little in taxes, and sometimes close to zero, even when their properties are generating real cash flow. The beginner takeaway is very simple. You do not have to shut down your business to lower your taxes. You just need to learn how to shift more of your income into smarter categories as you grow. And then when it comes to time to file, these income types determine which forms you can actually submit to the IRS. Most beginners get confused here, so let's make this part simple. The fourth concept is basic filings for business owners. No matter what, every individual files Form 1040, but the schedules and business forms attached to it can depend on how you operate your business and investments. So if you are a sole proprietor, you file Schedule C. If you have rental properties, the income goes on Schedule E. And if you run an S corporation, that requires a separate Form 1120-S. A C corporation uses Form 1120. To file correctly, your CPA needs accurate financials from you. That means bookkeeping that is updated before year-end, clean report, and organized documentation so the numbers can flow smoothly into the tax return. Once you understand the filing basics, the next step is building a simple tax plan that keeps you ahead for 2026. Let's walk through that, what it looks like. The fifth piece of building a simple 2026 tax plan. A beginner-friendly tax plan does not need to be complicated. It just needs to be intentional and actually match to how your business works. Step 1 is knowing your tax bracket, both federal and state. An easy way to understand your real exposure is to take last year's total taxes and divide them by your taxable income. That gives you your effective tax rate, which you can compare to your bracket so that you can see what you are really paying. Step 2 is choosing one or two high-impact strategies instead of trying to chase everything all at once. This could mean an entity and compensation review, planning for retirement contributions, or using trust structures when that is appropriate. appropriate for your situation. Step 3 is managing the timing of income and expenses. You can accelerate expenses into the current year or delay some customer payments into the next year to shift the tax impact on your return. Step 4 is system. That includes expense policies, accountable plan, accurate bookkeeping, mileage logs, and clean documentation that supports every deduction that you're taking. Step 5 is setting quarterly check-ins with your advisor. This is what prevents the April scramble when it's already too late to fix anything. But even with a simple plan in place, most business owners still miss the basic habits that save the most money. So let's finish with the quick wins that almost everybody overlooks. By the time we reach the 6th piece, we need to talk about the quick wins that beginners miss. Start by separating personal and business expenses completely. Use different bank accounts and credit cards so that your books stay clean and easy to read. Build a simple fixed asset depreciation schedule for any major purchases. You and your CPA can track how those assets are being deducted over time. Decide whether you are taking standard mileage or actual vehicle expenses, and then track them correctly so you have support for that choice. Have an accountable plan in place. Reimbursements to owners are handled cleanly and documented instead of being random transfers that confuse your book. And if you're operating an S corporation, make sure that you set a reasonable compensation so that you are not overpaying in payroll taxes or creating red flags. The differences between a tax-smart business and an overpaying business is not intelligent. It's a structure and strategy. And then when you keep clean records and choose the right models, taxes stop feeling mysterious and you start to feel more in control. Now that you understand how business taxes work at a high level, the next question is who is supposed to help you with all of this, a bookkeeper or a CPA? Most business owners think that having a bookkeeper automatically means having good books. But that is exactly how businesses waste $50,000 to $100,000 a year because the books are wrong. The CPA gets bad data, the tax return is built on sand. So if you're wondering who you actually need on your team and what role each person should play, watch my next video where I break down the difference between a bookkeeper and a CPA and how to build a team that actually protects you.